Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
About this for a moment, folks, is that the option is moving further statistically away from the 62 simple moving average than the spot is, but only slightly. So there is a lot of correlation, but for those of you who enjoy arbitrage opportunities and have a mind for statistics and mathematics, there are still some fascinating ways to compare the spot price to the options price. You'll notice at far right that we've got on the daily chart, we've got a doji. Now, that's just a reversal style candle. You could call it a hammer. You could call it a homoji. For that matter, you can call it a pregnant fairy candle or whatever you want to call it to me. But that is a significant that the currency just got whacked out today, and it fell a huge amount and then popped right back up, which is traditionally the sort of stuff that you start to see near the end. So, Steve, one thing that I will look at, and it's a very elementary and a very, very, very limited part of what I do, is I start to look at these statistical anomalies that occur at the same time when we're creating some type of price pattern that would ordinarily be associated with reversals. I'm going to go down now to a shorter time frame chart, and we're going to go down through these one at a time. And I'm going to start showing some things that I'm going to look at. I'm even going to go down further onto a 60-minute chart. And here's what I'm going to look at. It'll just take me a moment to set some of this up. Make sure we know what we're talking about here. Okay. Here's what I'm going to do. If I'm purely a spot trader, here's what I would think about doing, and this is why this was so important last year. If I was purely a spot trader and I didn't do anything except trade spot Forex or even options on Forex, if that's all I did, I could, for example, as simple as this, wait for a break above some short-term trend line, buy the currency pair on the futures exchange, or buy the currency pair on the spot market, and I could just sit on top of a position, and I could just try to ride it forever. Here are some problems with that mentality. One, do you have unlimited capital? The answer is probably not. The answer to that is probably no. So somebody's going to say, Steve, for example, someone's going to put in the equities world or in the spot Forex world or futures world, they're going to put a stop loss down here or something. Mm-hmm. And Steve, they don't have an unlimited amount of time on this trade. They can only stay in this trade for as long as they are solvent and as long as it does not hit their stop loss. And that's responsible trade management. You don't put yourself out there to lose an excessively large amount of money on some harebrained, crazy idea. But what you run up against is the fact that I might have this opinion that the spot Forex world is out of whack and that I want to buy the British pound and I want to be a part of that. Now that's interesting and that's extraordinarily awesome. What if instead of that being a stop loss, what if instead of focusing on how much price I have or how much time I have in terms of price, what if I focused on a put or call at this level? What if I focused on, for instance, at the same time I took the spot trade, what if I bought myself, instead of even taking the spot trade, what if I bought a call? And I had an expiration date of a month or at an expiration date of 2 months. Steve, in that case, I don't really care how far it goes against me in terms of price. I mean, I'd rather have it not go against me in terms of price, but it's not going to affect it's not going to affect my account in the same way having a spot trade go against me for 1,000 points is going to affect me.
Correct.
So not only could I just maybe, for instance, buy a call, which, is actually something that I've done. Maybe I bought a call. Not only could I just do that, and I could say, now I have 2 months for this to return upwards a bit. I don't have to worry. Maybe the trend on a bad day, maybe the non-farm payroll report comes out. And have you ever been stopped out on a non-farm payroll report when things get wild, and then it just goes in your favor anyway later on? I mean, that's pretty ridiculous, right? I mean, that drives me insane. What if instead of expressing my statistical opinion about the market in terms of that, what if I simply said I want to give myself as much time as necessary, and it can fly around in the short term, but after it broke that trend line, maybe I know I want to be a part of it. Or maybe I take a set of buy positions in the spot market, and I even stage them. I even take a number of buy positions in the market on the way up, and maybe simultaneously I buy a put, and I put a fixed investment in the market, and if the trade goes against me in the spot world, I have an appreciated investment in the options world that gives me time. So money that I'm making in the options world sort of replaces or helps me stay with an opinion that I have in the spot or the futures world. This is so important to me because oftentimes when I'm trading long term, I've got an opinion about the market that's reasonable, but I don't have necessarily exact notions or perfect notions of when the reversal is going to happen. And even if I did, I don't have actually perfect intelligence as to how far it's going to go against me in order to arrive at some destination in the future. Think about that again for a moment. If we go back to the daily chart, I'm going to remove all the tools off this so we can see it again. If we go back to the daily chart, the average or the mean is $1.48. We're 900 points below that level right now. Now, if I just bought a bunch of trades in the spot world, I could try to hang on forever, indefinitely, for all time. I could try to hang on forever. Or, instead of exposing myself to that kind of severe drawdown, I can buy myself time for that to occur. I could buy myself a couple months for that to occur. And because I don't know if the market's going to get more volatile or less volatile in the near term, and I don't want to be exposed as heavily to that, I can make decisions about my trades that allow me to have some protection or coverage that I wouldn't ordinarily have, for instance, if I just simply traded, right out of the gate and exposed myself to a stop loss and then kept getting stopped out only later on to see the market reverse and go in exactly the same direction as I thought it was going to go and have made me money because the market was able to stay irrational longer than I was able to stay solvent. That has got to be one of the most frustrating things in the world. I'm going to stop sharing for just a moment here, and I'd love to hear from those of you who have any questions about what we've done.
Rob, here's a question from Zaire. I guess, this is the $64,000 or $64 million question, whatever you want to say it. Can you show at what price you'd be buying the call? I mean, I guess it's two different things. You're looking at the value of BPX, and then you got to look at the options market. And then I'm not trying to overcomplicate this, but then you need to think about timing and your strike price. How do you look at that?
Let's just talk about it right now. Here's what I'm looking at. I'm looking at, in particular, to answer your question, I think it's a valid question, and I'm not here today to tell you I'm an expert about the options world. And let me say two things to preface this. Number one, if you sat me down with an experienced options trader, I'm positive that on the things that go well for me, I would extract much more out of my trading strategies because I could do a better job at finding the right option at the right price with the right expiration. So first of all, that's out of the gate. I never have been an expert in the options world. I use options as a tool to manage my risk. But number two, if I knew more about options, I'd probably lose less money when I traded options as well for finding the better ones.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcast.